Last agenda item here of a very full day in Ways and Means. We are going to work with Abby and Emily again, our brilliant team, to do another, it's not quite a 101, it's more of a 201, would you say? So if you want to join us.
Sure.
And again, refresh your web page. Presentations are up. Personal income tax.
Great. So thank you for having me back again today so soon. Abby Shepard, Office of Legislative Counsel. This is a little bit of a deeper dive. I just catch my breath walking up those 3 flights of stairs. So this is personal income tax. We will also be back, I think, tomorrow to talk about corporate income tax. You will be getting these sort of deeper overviews, not getting into any specific issues, but just reminding everyone how these taxes are structured and some of the issues that you'll see that come up every year. The first sort of substantive slide, I have my outline here. Again, this is just looking at personal income tax. I do have a link to my previous presentation yesterday. So I have set out sort of those 3 little parts that you saw in the calculation of a tax. So I talk a little bit about the base, the rate, and the liability. Then I'm going to talk about the annual link up. I do have some slides in here about that. I don't know if you want me to come back to talk about that in more in depth when you have draft language, but there are a few sort of technical aspects to that can have policy implications. As those of you who were here during the pandemic will remember, that became a much bigger issue than it ever has been before because of federal action that was retroactive. Typically, Vermont doesn't have to grapple quite with that level of uncertainty. So it is important to understand how the annual link works. And then I will explain some of the really major definitions and how that impacts Vermont. And finally, I will go very high level over a few of the changes last session. There were significant changes made to personal income tax. I won't go into the really technical administrative changes, but primarily the tax credits and deductions that were enacted. I'm having trouble catching my breath.
You're going to take her.
No, it's just very mess. Don't worry. So please let me know if you can't hear me. I'm not great at projecting my voice. I'm being used to talking to my computer over the last few years. Giving presentations is a little different. So on slide 3, looking at, you'll see Emily and I use this little abbreviation. It has no official meaning. We just like to shorten everything to PIT or CIT because it makes our lives easier. So PIT is referring not to PIT, but to personal income tax. So that's throughout the slide, any reference you see there. So since we did look at the anatomy of a tax yesterday, I've sort of laid it out and given you the definition as well as the statutory citations for how personal income tax is structured. The tax base is taxable income, and that can get pretty complex pretty quickly, but the basic idea for you to retain is that this tax is based on taxable income, and that is a Vermont definition. It's set out in section 5811, subdivision 21. Vermont's personal income tax is progressive. We did talk about progressive brackets and marginal tax rates. That is also in chapter 151 of Title 32, that's section 5822. Don't worry about remembering these. That's what I'm here for. I can always point you to the right statutory sections. In tax liability, I've cited an entire subchapter here because of all of the different adjustments that are made. There are many tax credits. That's the subchapter that I'm citing to there. That tends to be where there are lots of questions. There are a few adjustments to taxable income, and then the tax credits are applied. That's how you get your final tax liability, just to remind you from what we saw yesterday with the calculation. So that's really high level. Now we'll dive into some of the specifics. Annual link up. A lot of, in general, you'll see in statutes, I'm sure you've all seen this, Vermont statutes will often incorporate another jurisdiction's law or another part of Vermont statute, just a reference in the code. So it could be Short-term rentals, for example, this is a different tax type, but meals and rooms tax, it references a different title saying that definition in Title 18 applies to the meals and rooms tax for purposes of determining these taxable rentals. You can also have a reference where you incorporate federal law. So that becomes really important in personal income tax because Vermont uses federal law to determine its tax base and a lot of its credit programs. All of those pull in, almost all of them, not all of them, pull in federal law. There are a couple of different ways that this is done for personal income tax, and then corporate income tax also has a link up, and estate tax also has a link up. That's often in the miscellaneous tax bill. I think it was actually in a different tax bill last year, but it will come up when you are looking at federal definitions. There are two different parts to the annual link up. So first you have this reference to federal tax code. Vermont income tax says at the end of a given tax year, Vermont is going to pull in all of the federal definitions in existence on that date. So that is set in statute, and then each year, generally, the legislature decides to update the year. So I'm sorry, I've skipped ahead. I was on slide 4, I'm now on slide 5. This is section 5824, the adoption of federal income tax laws. You have the date, the statutes of the US relating to federal income tax as in effect on December 31st of 2021. Disregarding federal income tax rates are adopted for the purpose of Vermont income tax laws. What becomes slightly more complicated, moving on to slide 6, is what year those federal tax laws apply in Vermont. And that is in session law, that's in the effective date. And I've given an example of last year's bill that had the annual link up. That was actually a corporate reform bill. It applies federal statutes in effect to taxable year 22. So the tax year that just, it applies it starting I'm even getting a little confused. So it applies it starting January 1st, 2022, but it applies it to taxable year 21 because it's the prior year. So that means this year in 23, if Vermont decided to update its annual link up, it would apply starting January 1st, 2023, but it would look at taxable year 22. So when individuals are filing next year in 2024, federal tax law will apply to this taxable year, 23. And I could draw at some point or do a little diagram. There's sort of always that retroactive nature to it because you're looking at last year's income. So I just want to put that out there now. Hopefully we will talk about this again. I'm sure it will come up if there's a miscellaneous tax bill or any sort of technical bill. This language often sort of rears its head there, but I just wanted to get that out. Some of you have heard this many times. It's always a little confusing because the dates are retroactive. So pause there. It often makes more sense when you're actually looking at, for example, a federal change that just occurred. You look at how it applies to a particular tax liability, but I will pause there. Okay. Next, moving on to definitions. And I do go into a fair amount of detail. And again, please don't, I've added legal citations, some case law. Please don't feel like you need to have this memorized, but just to show that this does have legal basis. There has been case law on this. Some of these are very sort of long-standing tax principles. On slide 7, starting really broad, there is a definition of gross income under the Internal Revenue Code. So federal law sets out the definition of gross income. It's very broad. It means all income from whatever source derived, which then is subject to certain exclusions. Tax, a pretty old, trying to find the date here, 1955, US Supreme Court case interpreted that to mean income is any accession to wealth. So this first definition is very broad. And it's looking at examples, and these are taken from what you would report on a personal income tax return. It's any type of income. They're also laid out in statute: wages, tips, salaries, commissions, rent, royalties. There's a long list of what's considered gross income. Again, this is not taxable income. This is the biggest bucket of potential income that you start with from the federal definition.
Abby, in the federal definition, with that sort of definitional language, I understand that there are exclusions made in federal and state statute, but what is included, is that determined by rules at the federal level?
Nope, so that's statutory, that's in the Internal Revenue Code.
Great.
And I'm looking at the first few that I've listed, that's in Title 26 of the Federal Code, that's the Internal Revenue Code, Section 61. So wages, tips, salaries, and rent. Those are sort of your basic gross income. And then I've listed a few examples of things that have been in the news recently, certain cancellation of student loan debt, certain Social Security income. These things are statutorily excluded from gross income. Next, you have adjusted gross income. So that's the next section in the Internal Revenue Code, AGI, and you'll hear that discussed frequently. And that's gross income minus a list of exclusions and deductions. Common federal adjustments to gross income, teacher expenses, IRA deductions, student loan interest, tuition and fees, and there's a long, long list. I've set out many of them in here. These might sound familiar for those of you who've looked at household income, because a lot of those are pulled into that definition for property tax credit. AGI is used in a lot of it's used as a metric for a lot of different tax and other benefit programs. So these might be familiar to all of you. The next definition, so we started big and we're sort of carving away at it, is taxable income. And I'm now on slide 9. So taxable income is quite different from gross income. You have both federal taxable income, which is adjusted gross income minus either your itemized or standard deduction and lots of miscellaneous deductions. And then you also have Vermont taxable income. That starts with federal adjusted gross income. It doesn't look at rates. It doesn't look at bonus depreciation. And then as you've seen from both Emily and you'll see further down in the slides that I've added here, if you look at it as a chart, it looks a little simpler because you have gross income, you have adjusted gross income, and then you have taxable income. Vermont takes that adjusted gross income and adds back and subtracts certain things to get your tax base. I did want to note that Vermont taxable income, not only is it different from federal taxable income, Vermont used to use federal taxable income as its starting point. It no longer does that. As I mentioned yesterday, there are a lot of constitutional provisions that impact the work that you do here. There are a few to be aware of when you're interested in taxing certain income. States cannot tax absolutely everything. Some types of income are preempted by federal statute and the US Constitution. And then Vermont has the way to make policy decisions about other types of income. So a few that I've listed here that have come up in the last few years, railroad retirement income is federally preempted. That is in statute. There is some case law on that as well. Also, what's considered discriminatory tax treatment of federal source income in favor of state source income. That's been a question around certain types of retirement income recently. States are limited in how they can tax that type of income. So on slide 10, I'm laying out the federal income tax definitions that I just reviewed. You have gross income minus above the line deductions, and then you have your adjusted gross income. And I've noted that's what you see on Federal Form 1040, the most simplified version. And on slide 11, that AGI is the starting point for Vermont. You add certain items of gross income that were subtracted federally. For example, bonus depreciation, interest from non-Vermont state and local bonds. And then it subtracts different types of income. So Vermont created its own standard deduction and personal exemptions after the Tax Cuts and Jobs Act. And then there are several other subtractions. This is not an exclusive list, just an illustrative list here. Interest income from US bonds. Vermont has its own capital gains exclusion. There's the Social Security exemption now expanded to include several other types of retirement income, and then medical expenses as well. And that is how you get to Vermont taxable income. So that is the tax base. Okay, great. And that will be lots of, this is sort of the touchstone for a lot of the issues that will be brought to you that I hope you can sort of plug it into, oh, this is a change to the tax base or a change to an exclusion or adjusting rates or something along those lines. So hopefully this gives a nice base layer of understanding and what some of the terminology is. And I always find this interesting to look at how the tax base has changed over the years. So on slide 12, looking back to 2002, Vermont's personal income tax base used to be a percentage of federal taxable income. I didn't note this, but prior to that, it used to be a percentage of the federal tax liability. So Vermont was really hinged to federal policy decisions that it became federal taxable income in 2002. The starting point became federal. That's when it became federal taxable income. In 2017, actually prior to the Tax Cuts and Jobs Act, Vermont changed the starting point to federal AGI. And I think part of the policy decisions behind that was to have more control over what was flowing through, because taxable income is sort of further down in the calculation. If you start with AGI, you have more control about what is flowing through to Vermont. And that was right before the Tax Cuts and Jobs Act. So starting in 2018, Vermont's personal income tax base was changed further. AGI was retained as the starting point, but then there were multiple changes, which I've listed a few of the major ones on slide 13. The major changes at the federal level was, and I've noted, eliminated personal exemptions. However, these were suspended. I'm going to have that in sort of a smaller bullet point through tax year 2025. So these are actually suspensions unless there is federal action. These federal changes will, I want to say, revert back, because the suspension will no longer be in effect. So the personal exemptions and the standard deduction that were changed federally will go back to what they were before Tax Cuts and Jobs Act. Vermont decoupled from these federal provisions by shifting to state-specific definitions. So there are now Vermont standard deductions, there's standard exemption, personal exemptions. And then that means that some of these federal changes won't flow through to Vermont. So even though, at the end of 2025, so starting in tax year 26, the personal exemptions and the standard deduction will go back to their pre-2018 amounts federally. Vermont will have its own standard deduction and its own personal exemption. And then the last, went a little faster than I expected. That's the last two slides. I've provided links to the acts that were enacted last session that affected the personal income tax. The first one you'll see is Act 179, and that's technical and administrative changes. It didn't only impact personal income tax. That's one of the reasons I didn't go through all of it. It also impacts other tax types. The major changes that were made to personal income tax were in Act 138, and that enacted the Vermont Child Tax Credit and changed the Social Security income exemption. And these links should hopefully all work to lead you to the Act and the Act summary. My final slide on slide 15 lays out the basic framework for these changes. I'd be happy to go into more detail. It is actually always a little more complicated than what's on here, but the basic framework is that a refundable $1,000 credit was enacted. It's the Vermont Child Tax Credit for children who qualify federally, who are 5 and under. So that's actually a different age than the federal limits. It does phase out, so it has an income threshold for taxpayers with over $125,000 of AGI, and that's irrespective of filing status. And that means that the credit becomes $0 at $175,000 of AGI. I don't know if there are more in-depth questions. I'd be happy to maybe prepare something else if anyone has questions about that. That was a big change to personal income tax. There were also changes made to the child and dependent care. There were previously 2 credits So one was repealed and one was made fully refundable. So one was repealed, another was expanded, became fully refundable, and it is now 72% of the federal credit. So that's another way that incorporation by reference to the federal law that pulls through all federal definitions and ways of determining the credit. The Vermont Earned Income Tax Credit was expanded to 38% of the federal earned income tax credit. And Vermont enacted a new deduction for student loan interest paid. And it's only for a tax that also has a cap. So it's only for taxpayers with adjusted gross income of $120,000 or less for single filers, or $200,000 or less for joint filers. The Social Security benefits exemption, that was expanded by $5,000. So the threshold to qualify for that was expanded. There were also 3 new types of retirement income that were added into that section. There were different limitations applied. It's only for $10,000 of benefit income or retirement income. And it also added a limit that you could only choose one. So you couldn't both take the Social Security benefits exemption and one of the new retirement income exemptions. And I'd be happy to provide more information on that. I just didn't want to get too bogged down in the weeds, just to give you a high level overview. And that is the end of my presentation.
Thank you.
Great, thank you. Pass it over to Emily.
All right. Hi, good to see you all again. For the record, Emily Byrne from Joint Fiscal Office. Going to do a little bit more numbers, personal income tax, some fun charts, and it wouldn't be an intro presentation for me without walking through this sort of 6 principles and thinking about them through the sort of lens of the personal income tax. We'll do that and I'll jump right in. That works. Cool. Okay, so Abby just did a great job sort of walking through the personal income, the steps of the personal income tax. I thought I'd show it again in this presentation in a little bit of a different way. Just as a reminder, it's a good thing to be reminded of over and over again, I think. So the personal income tax starting point, right, is based on your federal adjusted gross income. So on slide 3, I pulled a picture of the actual tax form. And the line at the very bottom, you can't really read it. The line at the very bottom, that is your adjusted gross income. So you have to think of the things that are happening to calculations to income, like to calculate that adjusted gross income are things that flow through to Vermont's personal income tax. And the form is a good way actually to go look at what those things are, if you ever are curious. The next slide is probably the 4th time I've shown you this slide, and Abby just showed you this slide. We've seen it a lot, but this is that calculation of the Vermont personal income tax and what Vermont, or how to get to Vermont taxable income. And so we start with adjusted gross income. We add a couple things to bonus depreciation, interest from non-state and local bonds, subtract the standard deduction, personal exemptions, and a couple other subtractions, interest from US funds, capital gains, Social Security exemption, medical expenses, and that gets you to your Vermont taxable income. Go to the next slide. So these ones we haven't looked at yet on slide 5. But this is, okay, so once I calculated my Vermont personal taxable income, then what happens? That's when the rates come in. That's where you multiply by the rates. And we talked about the first, I'll use the single individuals on Schedule X on the left side of the slide, right? But so the first $40,950 are subject to the first rate, and then the first $1 over that is subject to the next rate. And then as you sort of walk through the bracket, the marginal dollars are subject to the tax rate as you walk through, as you increase your income from there, which is how we end up with that difference, right, between marginal and effective tax rates. Calculate actual paid over your income. So after you apply those rates, you come to your Vermont tax liability before credits. And the next slide, on slide 6, walks through what those credits are. So once you have your tax liability, first you subtract your non-refundable credits. So those are a lot of the ones that Abby just talked about. Credit for child and dependent care expenses, credits for the elderly and disabled, investment tax credit, charitable tax credit. And we subtract the refundable credits. So the big one is the earned income tax credit. And then as Abby spoke about this year, we'll also include, in 2022, we'll also include the child tax credit. And you multiply that by Vermont apportionment, right? So the income that's tied to Vermont or associated with Vermont is taxable in Vermont. And that equals your final Vermont tax liability or the refund that you receive from the state. So I like these slides, just kind of do a good job. Graham Campbell should get full credit for all of them. He put them together. I 100% stole them from him, but they do a great job kind of walking through those sort of steps in the process, I think. So I just thought I'd start out with that sort of high level overview and those visuals. It's just a nice way to kind of lay out the personal income tax. And so then I pulled in some slides on some of the numbers around personal income tax. Like, so what does this mean for Vermont's revenues? On slide 8, this is just a history of, not adjusted for inflation, of total dollars that we've received from the personal income tax since 2005. And you'll see that it's been increasing since 2005, the amount of PI that we're pulling in. Doesn't really have any flags or anything for things that have changed in the code that may have impacted increases and decreases in that.
Representative Bodie?
When I'm looking at all these income tax receipts, I'm thinking about what Commissioner Craig Folio talked about, all the money, $200 million that isn't being collected. And I just wonder if you think that does that fit in with what you are thinking about there?
I'm not sure what $200 million he was.
Was the tax gap,
Tax gap.
the difference between what
Federal.
annually sort of people owe and then what the tax department is able to collect.
This is the actual number. This is the actual receipts that came into the state. So to the extent there's money out there we're not collecting, that wouldn't be reflected in this. This is.
And that's not your bailiwick anyway.
No. So yeah, this is our actual dollars that came in. One of the things to point out, you can see the in gray, that's when the economic recession happened, or the Great Recession happened, and you can see there was a dip in personal income tax receipts. I know we've talked a little bit about sort of the volatility of personal income taxes, and I think, granted, that was one of the biggest economic crises the country has seen, but you can see how that really impacted receipts in that time period. And then conversely, you can see when you get to this current year, 2022, and then sort of projected decrease, what happened during COVID, the feds, we all are aware the federal government pumped a whole bunch of money into the economy, and a lot of that came through unemployment insurance. So the amount of money, income for people went up partly due to unemployment insurance. There were, certain businesses had increased profits, so people had more income, asset values increased, people were getting capital gains. There's just a sort of, we'll hear more about that kind of stuff when Tom and Jeff come and do the economic forecast, but there was some COVID impact on the personal income tax that they have projected. When they did their projections in July, so this is based on the July numbers, they projected that some of that federal stimulus will have sort of finally made its way all the way through the economy, and then there'll be a little bit of a dip in, to caveat that. It looks like there's a dip in personal income tax, but if you kind of draw a line from the history up to where it's going, it's actually kind of like there's a bump. But the trajectory of the personal income tax is kind of going to go back to where it was pre-COVID. I don't know if there are any other questions on the history of collections. Keep going. Cool.
What does that mean? Sorry.
Yeah, go ahead.
The 59.5% of available general funds.
Yes, so of all of the forecasted funds that's going into the general fund, the personal income tax is now almost 60% of total funds. I know we looked at a chart that, across all of the funds, it's about a third of receipts. The general fund only gets a chunk. As a percentage of total general fund, it's only about 60%.
So this is telling us to hang on to our chairs because this is not going to continue. It's good news that we've seen on the reports regarding personal income tax, feeding the ed fund, feeding the general fund, though that's going to stop. Is that what this is saying?
I don't think it's saying that. I think there's a adjustment for the sort of one-time activities of COVID will likely happen in the general fund, but there is, yeah, it's hard to say. That's a good economist question.
And so the board is next, early next week, and then right after that, they'll come in and we'll get to like dive into all of the projections,
Yeah.
which I always find very exciting.
Yeah, I like to listen to those guys too.
Yeah. And since I don't know what they're going to say on Tuesday, I don't want to get ahead of, this may be different, this may look different in 3 days.
I figured you must have the
No, not yet. Not yet.
thank you.
Yeah, sure. So on the next slide, this is a summary of actual tax returns for tax year 2022. I'm on slide 9. So the tax department publishes all this data at the end of the year, but this gives a high-level overview of the AGI brackets. And they're not the same amount, so this isn't a perfect, like quintiles or whatever, sort of tried to break it up. So it's about similar amounts, I think, or similar, I guess.
Can you explain yourself a little
Yes.
bit better there? So, sorry.
Of course. Happy to. So I just was pointing out that like you'll see it goes from negative to 25,000, 25,000 to 45. The changes in income aren't like 10,000, 10,000, 10,000.
So why did you divide it that way? That was actually my question. Sorry, I didn't.
That's a good question.
Explain my question very well.
No worries. The tax department data doesn't break it down consistently. So it was just sort of trying to like bucket it in a way that kind of made sense. But just wanted to acknowledge that it's not sort of like a perfect, like that. So this gives a summary of, how many returns in each bracket and the sort of percentage of the total in each of those brackets. So you'll see at the, in the number of state returns, there's a lot of returns in that lower income piece. Almost 30% are under $25,000 number of returns. And sort of as you go up, the number of returns starts to decrease as AGI goes up, which you would expect. And then the next column is, so how much was paid in taxes from each of those groups. So you can see there's sort of an inverse relationship, and then there's more returns at the lower end, but the percentage of taxes paid, and in this case at the lower end, they actually receive money from the state, versus the high end where there's a lot fewer returns, but a larger percentage of the total taxes.
Again, this doesn't reflect tax brackets nor
Correct.
quintiles. Okay.
Yes. This is just sort of breaking down the incomes into buckets.
And I don't mean that as a criticism. I just wanted to make sure I was.
Yes, no. So I wanted to present this in table form because some people think in tables, and then the next slide 10 is a chart, which is the exact same information, because I know some people do better with charts and visual presentation. So this is the same information, those same cohorts of taxpayers. The blue bars reflect the number of in-state returns. I should say that was all in-state return information. For out-of-state returns, we don't have the detail on what AGI income group they fall into. We just have the total number of out-of-state returns. Last year was almost 70 million, or in 2020 it was almost 70 million.
Madam Chair. So the feeling on Ways and Means back in the dinosaur days used to be that in those first two groups, so the group would be up to 24,999, and then the next group up to 44,000. Those two groups filed mainly to collect on the earned income tax credit, not to pay and, true up their own forms.
Yes.
Is that still the feeling?
Yes, I think you can see that in the negative amount of taxes paid. So that
Right.
negative amount is actually the credit that's being paid out to those groups.
Okay. So is it just in the first bracket then, not the second one? There was some tax paid there in the up to 45,000. And
Yes.
I guess it doesn't really matter. The point I wanted to make was about the earned income tax credit.
And I think what is likely going to change, and I'll talk about it on the effective tax rate chart too, is the impact of the child tax credit on that as well. To the extent that has a pretty high income threshold, and anybody with kids 5 and under is going to get that tax credit now, that refundable tax credit. That may actually, the picture next year, or we won't be able to give it to you next year, 2 years from now, we're able to pull the 2022 actuals, that this will look different because of that tax credit change, and that more people will likely get refunds than current.
Because that's refundable.
Because it's a refundable credit. And it will sort of shift things.
I was worried that sometimes this is going to put that at risk.
Mm-hmm.
Because if you look at the results you get from providing those lower income families with a little extra money, it's money that goes right into the kids, into food, daycare, clothing. And if you know, I don't know, sometimes I think that people will say, well, gee, we shouldn't be giving that money away if it's the only reason they're filing. I mean, no, it helps. So I guess that's more of a personal feeling than any kind of fact I wanted to bring out. But I do worry that puts the earned income tax credit at risk. Maybe not, but thank you.
Yeah. So I'm still on slide 10. I don't know if there's anything else to say here. Yeah, just where the blue bars, number of returns, the orange line is the amount paid by each of those groups, and you can kind of see that inverse relationship that I talked about in chart form. And there. And then the next slide, again, this is another one I think I've shown you 4 times in the last week and a half, but the chart of the.
We notice.
Right. I should change the color. So everybody. No, the line change, the color line changed. But yeah, sort of same chart with that effective personal income tax rate showing the progressivity of the Vermont income tax. One thing, and again, and this is another chart that will change in 2 years when the child tax credit comes through. And I think what we'll see is Abby, you can correct me if I'm wrong, 150 is where it caps out, and then 175 is where the child tax credit completely goes away. I think what you'll see is sort of up to that 150 as that line is going to kind of move down because people's effective tax rates will drop as they get that credit and their tax liability decreases. So there'll be kind of that line will move down, and then it will look like a bigger jump at the higher end as a result of that. Just wanted to put that on your radar.
This might be premature, but how would, I'm wondering out loud then, how will the tax credit and if we were to try to do something with helping with paying for childcare not being more than 10% of what someone earns, I wonder if those two things will get linked at all.
One thing that we keep on talking about sort of just across the legislature is what it would look like to overlap maps of people's incomes and tax rates and all of that with a map of benefits, various benefits that the state uses, maybe even including corporate benefits, or doing the same thing on the corporate side with corporate taxes and corporate benefits. But I think that's a project that we haven't sort of formally asked JFO for, and I think would be a summer project.
You might be dizzy. Maybe 2 summer projects.
Yeah. But it's to get a comprehensive picture of how a family experiences it rather than how it's experienced by the populace.
Very much.
All right, so those are the numbers that I thought were important to bring through. And then thought I'd quickly kind of go through the 6 principles, how you frame the current income tax system through the sort of lens of those principles. So starting with the first one, sustainability and reliability. We've talked about sort of the volatility in the personal income tax relative to other taxes. And, you can see that in the, as we talked about in the recession, what happened during the economic recession and what happened during COVID in the other direction, right? So it's not just it tanks when the economy tanks, when things are good, things are better on that side. So individual incomes can be impacted by general economic conditions. One-time events can impact, individuals' income tax liabilities. When they sell a business, they may have a big spike in their income tax liability and then it will drop back off. And depending on how you introduce greater progressivity, there we go, into the tax code, it could mean greater volatility just in that are people with higher incomes able to port that income or treat it differently potentially? And if, as things change, what kind of happens on that to the extent we get a good, what's the number? It's on my head, a third of the personal income tax receipts come from 2% of taxpayers, being aware of sort of what happens to that group as changes are made. And then on the reliability front, we talked about this yesterday a little bit, but demographics can have an impact on the sort of long-term trajectory of the personal income tax. Vermont has an aging population and a shrinking workforce, which means less wages, and retirees generally have a lower income than working population. So as the population shifts into that cohort that's not necessarily getting salaries, that can impact the amount of income tax that we have over time. We talked about this, right? As income inequality gets greater and you get a greater share of tax receipts, smaller number of high income filers, kind of makes the tax itself a little less reliable. And similarly, Abby talked about the linkages to the federal tax code and what's historically changed over time, but to the extent Vermont is linked to the federal tax code and we have to react to changes in the federal tax code, that can kind of impact how reliable it is if we're sort of subject to needing to make major changes or they make changes that flow through and impact what we're going to collect. On the fairness side, so Vermont's income personal, we've looked at the chart 4 times, right? We've got a progressive personal income tax that really promotes vertical equity. So reflecting people's ability to pay. The higher your income, the larger a portion of your income that you end up paying in income taxes. We've talked about the ITEP report, which we've talked about it more at the sort of like global scale of our entire tax code, but ITEP also says we have one of the most progressive income taxes in the country. And I think it will be interesting to see how we get ranked with the inclusion of the child tax credit, make it more progressive, and how we stack up against other states.
And our earned income tax credit went up significantly at the same time.
Yes, that's right. There was a percentage change there. So those 2 things will have impact there. On the simplicity side of things, there are, we've got credits and deductions and exemptions that have been introduced in the tax code that make it more complicated, but it does make it more fair and more progressive. So as the sort of decisions are made about whether or not to include more or get rid of some, that impacts sort of how simple the tax code ends up being. And we can gain complexity in several areas of the tax code. So how do you define what income is, what's in and what's out of that income calculation? Right now, you calculate the income and then we have the rate schedule that applies to that income, but you could tax different kinds of income at different rates, right? That would make things a lot more complicated, but that's a thing that could be done. And then, making the policy decisions about what deductions, what credits stay in or go out or go up, go down, et cetera, can complicate the tax code. Economic competitiveness. So this is, how do we stack up against other states? One of the things that's challenging about the personal income taxes is actually kind of difficult to compare it across states because states make different decisions about what's in and what's out of their income calculation in terms of their rates, and the brackets are different across states. So it can be difficult to easily, what deductions they have, what exemptions they have. Not everybody lines up easily. So it's hard to kind of compare across states, but in thinking about making changes to the personal income tax code, thinking about how that comports with what's going on in other states. Generally, we have lower effective tax rates than most of New England at the low end, but once you get to the sort of higher end of income, ours are our effective rates go up steeply. I think that's a reflection of when the highest bracket kicks in. Is it like around $250,000, which a lot of other New England states, that highest bracket doesn't kick in until a higher level of income, so that kind of impacts that effective rate piece. Tax neutrality. So this is the idea that the tax code itself drives behavior of people. We do have there are some decisions within the personal income tax code that attempt to change people's behaviors, which is the capital gains exclusions and the investment in research and development tax credit. 529 tax credit is an example of that, to try to incentivize people to put money aside for college, get a tax credit for that. There's also the charitable tax credit. So you can take a 5% deduction on the first 20,000 of donations. It's different from the federal deduction, but it was added to try to encourage people to donate to charity and then get a tax benefit for doing that. Then the last principle, accountability. So the way that one of the ways that we hold ourselves accountable on the personal income tax is through the publication of the Tax Expenditure Report, which I believe we've talked about, and we'll come in and do a big presentation on the Tax Expenditure Report next week. But that's every 2 years, JFO goes through all of the tax expenditures and provides some details on how much they're costing the state, because they're effectively foregone revenue through the tax code, and we do both the tax expenditure report, which goes throughout all of the tax expenditures for all of the tax types and outlines sort of what's going on in each of them. And then we do what's called the tax expenditure review, which is more of a deep dive into a specific tax expenditure. It provides a little bit more economic analysis, a little more policy overview. This year, we did one on the earned income tax credit. It was a sort of big review that we did, and sort of us as staff looking at those and flagging any sort of issues or challenges or things the legislature may want to think about in reviewing those tax credits in terms of whether or not the statutory purpose that's outlined in the law aligns with what's actually happening with those tax credits.
Madam Chair, in the case of some of those expenditures which are intended to change behavior, your deep dive, does that try to round up the analysis which either vindicates that the behavior has happened or not? Or do you just describe what's self-evident, namely the purpose behind which the expenditure was created?
I think we try to do that where possible. Sometimes there isn't good data on whether or not it's happened, or, to the extent we don't want to make inferences, right, based on the data that we do have, but try to look at sort of bigger picture.
And across presumably a wider net of academic included articles on similar programs in other states,
yes,
all that stuff. Okay, thanks.
Yeah.
Where can we get a copy of that earned income tax credit report?
It will be out on the 17th.
17.
Yes.
Okay.
Yes.
And it will be, I think, sent to all of us pretty quickly.
Okay.
Yeah.
Great.
In 2020, there are 20, other than the personal exemption and the standard deduction that folks take, there were 24 tax expenditures in the personal income tax code that totaled about $72 $78 million worth of tax expenditure. Of note, Abby went through the Act 138 last year, which had a bunch of new tax credits in it. The big one being the child tax credit, which is anticipated to cost about $32 million, which is bigger than any other tax credit that we currently have. Is that right? Yes, it's bigger than the earned income tax. It's projected to be larger than the earned income tax credit. So there'll be a shift in 2 years in terms of what the level of tax expenditure is from the personal income tax. Additionally, there was the military retirement, student loans, Social Security deductions that were tweaked as part of that law, and that was about an $8 million cost or tax expenditure, or estimated to be that. And then the last slide, slide 19, is just a high-level overview of what some of those bigger tax expenditures in terms of their piece of the total tax expenditure pie. So right now, we're in 2020 and in 2021, the earned income tax credit is the biggest tax expenditure in the personal income tax code, followed by the capital gains exclusion. Then the other ones are a fair amount smaller from there. But the tax expenditure report will have details on all of them, not the ones in the other section. That's all that I have on personal income tax.
Yeah.
So.
With these projections, do you take into account what I see as a big shift in wealth from baby boomers to their kids? Myself as a baby boomer, looking at the wealth that I hope may end up transferring to my offspring. Mm-hmm. Does that get counted into your projections?
In the tax expenditure projections, or
no, just in personal income projection taxes of how much it will be.
So it gets accounted for. Is another good Tom Quebec question. How it accounts for that kind of stuff, but to the extent that flows through either through the estate tax potentially, or how that is going to depend on how that money is ultimately transferred to that age group and whether or not it is income, does it end up qualifying as income or?
Yeah, but it's not just the state. Mm-hmm. I mean, when baby boomers are planning, they're planning to perhaps have the last check bounced. But up to that point, they're transferring wealth to their offspring. Mm-hmm. So it's not just the estate, it has to do with how they use their required minimum distributions and all kinds of stuff like that as they're getting older.
Yeah.
We're getting older.
Is that another good question?
I think so, yeah. How does that get factored into?
Yeah. So that would be good.
Thank you. Yeah.
Any other questions?
Cool.
Thank you so much.
Yeah, anytime. I'll see you again tomorrow.
So we will see, we're going to go to the floor. We're not going to meet after the floor today. We've had a very full day already. Tomorrow is